All right, hi everyone. Good morning, good afternoon, perhaps even good evening, depending on where you're joining us from today. My name is Ryan Agee. I'd like to welcome you to today's Altair Global webinar, Current Market Trends Impacting Talent Management. We do value your time and appreciate you planning to join us for today's topic. Before we get started, I'd like to take just a minute to address a couple of housekeeping items. Please note that you've been muted by our phone system today and you're in listen-only mode. However, it's not a bad idea to go ahead and mute your phone or microphone just for good measure. We do encourage you to submit topical questions throughout the duration of today's webinar. If you have any questions during the presentation, please submit them in the question and answer window of your screen, and we'll do our best to respond to each question by the end of today's session. Please also note that this webinar is being recorded and will be available in a follow-up email after the webinar is concluded today. So if you have to jump off for any reason, you can catch the rest of the session in the recording. You can also download today's handout in your GoToWebinar control menu for printing, following along, note-taking, etc. And lastly, this webinar has been submitted for continuing education credits through Worldwide ERC and HRCI, and those activity IDs will be shared toward the end of today's webinar. All right, let's get started then. Again, my name is Ryan Agee, and I have the privilege of supporting a variety of open innovation and customer experience initiatives here at Altair. I get to work with a cross-section of Altair internal departments and subject matter experts, as well as supplier partners, and client partners, and other external resources to identify some new and creative ways to enhance Altair's mobility service offering. If you'll indulge me just a minute, I'd like to give a little background on the genesis of today's webinar. So to drive one of Altair's more recent service line enhancements, we engaged Hub International, which is a leading North American insurance brokerage, to help our customers navigate the sometimes complex landscape of personal lines insurance. So think homeowners insurance, renters insurance, auto, etc. We felt then and still feel that securing the right insurance coverage is a very important aspect of settling into a new home and a new location. And after evaluating several prospective partners, we entered into what we regarded then and still do as a very well-suited and strategic partnership with Hub International. Very grateful for that partnership. So by late 2019, Hub began offering insurance brokerage services to certain sectors of Altair's customers. So we're almost to the 2-year mark in the partnership, and I've come to work very closely with and highly regard Jen Martinez. Jen is Senior Vice President of Strategy Implementation and Strategic Partnerships for Hub. Her areas of focus include building and expanding Hub's customer base through market alliance programs and executing Hub's personal lines insurance, strategic planning and roadmaps. So prior to joining Hub, Jen also held multiple field and headquarter roles with Nationwide Insurance, including serving as Chief of Staff for Nationwide's newest CEO back in 2019. And so Jen, as I welcome you to our virtual stage today, I just wanted to recognize you and thank you not only for conceiving of today's topic, but collaborating on the webinar's development and especially for engaging today's featured speaker, David Berson. So with that, Jen, I'm going to yield the floor to you for your own words of welcome and for David's introduction.
Thanks, Ryan, so much. I'll do a quick sound check. Everyone can hear me okay? Sound good. All right. So thanks, Ryan. It's great to be here, and I really appreciate both you and our collective team's efforts to create today's event. So again, I'm Jen Martinez. I lead sales execution and partnerships for Hub International Personal Lines. We are one of the top 5 global insurance brokers with over 1 million clients, and we're a powerhouse in the personal line space. It's a particular passion for us and for me myself. Think of auto, home, renters, those types of products. We're a #1 personal lines broker in North America with strong digital omni-channel capabilities. What that means is for our partnership with Altair, we collectively reflect a commitment to protecting what matters the most for customers in order to curate a stress-free relocation experience for you and for your employees. This event just continues to reflect a partnership that is so much more than transactional, which is really Altair and Hub's ethos, by delivering thought leadership from one of Hub's most trusted, respected national carriers, Nationwide. Nationwide is a Fortune 76 with a strong mission to protect people, businesses, and futures with extraordinary care. And today we have the privilege to hear from their chief economist, Dr. David Berson. You may reference his extensive economics background with highlights in housing and mortgage lending here on the slide. However, I'd ask that if you'd allow me to share just a quick personal story. So as a Nationwide alum, I've personally witnessed the impact David has had on business strategy and operations. Just last year during COVID, he was at the tip of the sphere as nationwide, its businesses and their customers and partners navigated an uncertain environment with lockdowns. His insights and analysis directly contributed to nationwide strategic agility, and Nationwide was one of the few insurers that not only retained customers, but actually grew in 2020. His work continues to be impactful, and I'm excited that you'll have the chance to hear directly from him as your own organizations continue to navigate volatile and unprecedented environments. With that, David, I'll turn the floor over to you, and thanks again for being here.
Jen, thank you. Pleasure to be here. I want to thank Altair and Hub for inviting me to speak today. It's great to speak to you all today. Those of you who work for firms that have economists, and I've looked at the preliminary attendance list, and several of you do, check with them. I know most of them as well, so you can ask them if you think what I'm saying is right or not. You know, as you add economists, though, the number of opinions goes up exponentially. So fortunately, you have only one here today. I can only give you 2 hands worth of opinions. Let's go to the first chart, please. We're going to talk about what the environment is that your businesses are facing today and what we think the environment will be over the next year or so. So I always start with GDP as an overall measure of what's happening in the economy. And the blue line here is the level of GDP. We have data through the second quarter of this year. And what's important here is that the level of GDP is above where it was before the COVID recession began. So we've recovered everything in terms of economic activity that we lost during the COVID recession. The tan bars are growth rates, and you can see that big bar pointing downward. That was the biggest drop in GDP in American economic history, even worse than any quarter during the Great Depression. It was the worst. But look at the bar going upward afterwards. And that was the third quarter of last year, the biggest growth that we've ever had in U.S. history. And since then, you know, it's been more muted, but pretty good economic growth. So we had the shortest recession, but one of the deepest ever, and then very strong growth afterwards. And we're no longer in a recovery. We're in an expansion now. Go to the next chart, please. What do we expect to have happen for the economy? Well, this year, economic growth is likely to be the strongest since 1984, at almost 6%. Let's call it 5.5 to 6%. Next year, a lot of momentum. We think growth is going to remain very strong. Now, over the period since World War II, U.S. economic growth has averaged about 3% per year. So you can see that we're well above that this year. We think we'll be well above that next year. But in the period since the Great Recession, so just over the last 12 years or so, growth has averaged only about 2%. Well, if we go out to 2023, we expect growth to continue to slow. Now, part of that is as we get closer to full employment, and we will get closer to full employment, it's harder for the economy to grow very quickly. Just don't have enough people. But we're also expecting tax increases starting next year, and we're expecting at some point, probably the end of next year, perhaps in 2023, the Federal Reserve to start tightening monetary policy, pushing interest rates higher. So we have the strong momentum now being countered in future years by higher taxes and higher interest rates. But for now, very strong economic growth, and for next year, very strong growth indeed. Next chart, please. Well, we can see what's happening with the economy by looking at the unemployment rate. You can see that the spike that we had in the spring of last year, you know, in February of 2020, the month before the recession began, the unemployment rate was at a 50-year low, 3.5%. Within 2 months, it had gone up to almost 15%. And that almost certainly understates the actual unemployment rate. It's not too much to say that for a brief period of time, we had a depression level of unemployment in the United States. But today, given how fast the economy's come back, the unemployment rate is back down to almost 5%. pretty rapid decline to a relatively low level. We're not to where we were before the COVID recession hit. But by the end of this year, the unemployment rate should be under 5%. And by the end of next year, the unemployment rate should be under 4%. So that takes us back by the end of next year to an unemployment rate that is almost as low as what we saw before COVID hit. What's remarkable is the level of economic activity, again, has surpassed where we were in the pre-COVID period, surpassed that peak, yet the unemployment rate is still much higher. The number of people working in the US, about 6 million fewer than we had at the peak before the COVID recession hit. And that suggests that productivity gains, how much each worker is providing to their firms, is very, very strong right now. Go to the next chart, please. Here's our outlook for unemployment for all of this year, 5.5%. That's down from the 8.1% last year, and that included the 15% briefly. Next year, 4.3%, but again, ending the year under 4%, and then for 2023, probably under 4% for the entire year. That's a pretty tight labor market. The labor market's already pretty tight, even with the unemployment rate still a little above 5%. If you look at business surveys, whether it's small businesses or big businesses, they all complain they can't get qualified workers. And in fact, the National Federation of Independent Business does a monthly survey of small businesses, and the share of small businesses that have responded that the biggest problem they have is now lack of qualified workers has risen to an all-time high. And that survey goes back into the early 70s. So it's a long period of time in which they can look back to have this problem. Next chart, please. Well, one of the things that has really helped push this economy strongly forward, and one of the reasons why it was the shortest recession on record, was tremendous amounts of government spending that helped really kickstart economic growth. Here we have two lines. The first one, is the blue line, shows the increase in government spending that we saw as a percent of overall economic activity during the Great Recession, the 07 to 09 downturn. And it picked up after a few months, and it was reasonably large relative to previous recessions. But it wasn't until a year after the recession began, a little bit more than a year after the recession began, that we really started to see a significant pickup in government spending. It ended up being about, at its peak, about 5 to 6% of GDP. But look at the tan line here. That's during the COVID recession. Within a month, not 13 months, 1 month, government spending picked up to more than 10% of GDP. And a year later, which was earlier this spring, spending went up still more. So we have tremendous amounts of fiscal stimulus in the economy now. We may get more with the infrastructure bill and then the human capital bill now being discussed in Washington, D.C. The fiscal stimulus may be even greater. But this is clearly one of the big reasons why the economy recovered so quickly. Now, the most important reason was we got vaccines. And so why did we have the downturn at all? It was COVID. It's the COVID recession. But after that, and so people were no longer as afraid to go out, and governments actually allowed us to go out, it was the increase in government spending that really boosted economic activity. Go to the next chart. I think we have our first polling question. And we do. So I mentioned we have two different tax and spending programs out there that will be voted on perhaps by the end of the month, probably by the end of the month, but not certainly. So you saw how much spending there is in the economy and how quickly the economy is responding. So will the tax and spending package, it probably should be packages, be a positive or negative for the economy over the next year? You have two choices. It's either yes, it's going to be positive, no, it's going to be negative. So we'll give you just a second to put your selections down. We'll see what people think. Clearly, the spending packages that we've had thus far have been strongly positive for the economy. But will they continue to be? go to the next chart and see what the results are. All right, most of you think it will be positive. Vast number think it will be positive. Only a small percent think it will be negative. And indeed, in the short run at least, it will help boost economic activity. The concern, though, is that we will have fairly significant tax increases to pay for the spending. We did not have significant tax increases to pay for the spending that we've had over the last year and a half. And while we don't like budget deficits, we also don't like big tax increases. It's likely this would be the biggest tax increase to hit the US economy since 1968. And that is one of the reasons why we expect growth to slow going forward. Go to the next chart, please. All right, here we go. What's actually happening with COVID right now? This is daily infection rates. We're giving you a 7-day moving average. Otherwise, the data just bounces up and down a lot. And you can see increases, decreases. The big increase that occurred last fall and into the winter, and then it fell dramatically. Another little bump in the spring, and now the bigger bump with the Delta variant. But if you look at the far right on this chart, you can see that the 7-day moving average of new infections is starting to move down. It is quite likely that we are past the peak of the Delta surge. And this actually corresponds with other countries such as Israel and the UK we tend to look like them, but with a lag. And they're well off their peaks. It looks like we're well off the peaks as well. And it's quite likely that new infection rates will fall dramatically over the next several months. We certainly all hope that is the case. But we're not going to see new infection rates, certainly not hospitalization or mortality rates, anywhere close to what we saw at the previous peaks in the COVID pandemic. So I think we're past the peak now. Go to the next chart, please. Now, what impact has COVID had? This is seated dining. So not eating at home, although you may sit at home too. So people go out to eat, seated diners. And it starts with in the beginning of February of 2020, before COVID, and that's 0. And you can see how rapidly it went down to effectively nobody going out to eat at all in the spring of 2020. But it's come back, and actually earlier this summer, just before the Delta variant hit, we saw seated dining back to the level before COVID hit. It's gone down a little bit since then. Not much, down a little bit. And if in fact the Delta variant has peaked and we're past that peak now, it is likely we will start to see dining out pick up again. What's important here is, even with a small decline, that was mostly people deciding they didn't want to go out. It wasn't state and local governments deciding for you couldn't go out. That was the big thing that pushed economic activity down, was the governments basically shut down in-person activity. Lots of firms could continue to do everything from home. I'm working from home now. So lots of financial services firms, for example, never skipped a beat. But in-person businesses were really hit hard by the COVID downturn. The modest decline that we're seeing with seated diners is clearly not a positive for restaurants, but it's not nearly as bad as what we have seen previously. And if the Delta variant has peaked, we will start to see seated diners going back up again. Next chart. Air travel. TSA keeps good figures on air travel. And here, air travel went down after seated dining went down. So people stopped eating out before they stopped flying. And obviously, very few people flew last spring. It's come up again. In the summer, we had a small peak. Now, not as high as what we saw last year. So unlike people going out to eat, air travel has not yet gotten back to the levels that we were before COVID hit. But we're getting close. At least we're getting closer. I've flown a couple of times in the last couple of months. What's interesting is there's very little business travel. There's lots of personal travel, lots of families, not many business people. But again, if COVID is diminishing, the Delta variant is diminishing, we should see passenger travel go up again. Next chart, please. I showed the unemployment rate and how rapidly that's going down. One of the other things we look at with the job market is the labor force participation rate, the share of the working age population that is either working or looking for a job. And it has gone down for many years. Demographics, population's aging, a lot of the older folks in their 60s, I'm in the older 60s, I'm in that older group, decided they wanted to retire. So we saw, for example, from 2000 until 2015, a decline in the labor force participation rate. Now, a bigger decline during the Great Recession, as people simply left the labor force. But it picked up a little bit before the COVID downturn hit. But look at that sharp drop in 2020. We've never seen anything like that. Again, these are not unemployed people. These are people who weren't even looking for it, so they can't have been counted as unemployed. They just left the labor force. It's come back some, stabilized, but it's much higher than it was a year ago. Interestingly, there are three groups of people that we see comprising the categories that have really pushed labor force participation down. Number one, older adults who've just decided to retire. They may not come back to the labor force at all. Once you retire, it's hard to come back for many reasons, including the fact that once you retire, many people like that. But it's harder to come back into the labor force if you're older and you have retired. So many of those people will not come back. Second, people who are afraid of COVID. Be afraid for good reason. As the share of the population that is inoculated or is natural immunity, because they got COVID and recovered, and most people get COVID to recover, continues to go up. The share of people who are not even looking for work because they're concerned about catching the virus will go down, particularly if they are vaccinated as well. The third group, and this is the most important group, I think, are people who stayed home to take care of their children. Now, one of the things that we saw during COVID was virtually all schools eliminated full-time in-person learning. At least that's true for public schools. And for many households, somebody had to stay home. Well, typically a woman stayed home, even in two-parent households. It was typically a woman, and we'll see in a minute what happened to the labor force participation rate for women. But now that we are seeing in most of the country a resumption of full-time in-person learning, we should start to see people who stayed home with the children coming back to the labor force, and that is principally, again, women. Go to the next chart. I think that's what we're going to see now. Yeah, here's the labor force participation rate for women. See how it went up a lot more than the overall labor force in the couple of years before the COVID recession hit. And then it looks just like the whole economy. But we should start to see this come back significantly. This only goes to August. As we get to the September, October, November numbers, I would expect to see the labor force participation rate, and particularly for women, jump significantly. Now that's going to help a lot with businesses finding workers. Again, the biggest problem most businesses face today, the lack of qualified workers. If people come back into the labor force and start looking for jobs, that will help reduce that problem. It's not going to eliminate it, certainly not all at once. Perhaps if this expansion goes on long enough, it will be eliminated as a problem. But it will mitigate the problem starting, we think, in September and make it easier for firms to find qualified workers. Next chart, please. All right, here we have our next poll. We're going to talk about inflation in a minute. Now, I will say this. I think everybody knows inflation has picked up significantly. So here's the question. Will inflation continue to run hot next year, or will it slow? You know, the chairman of the Fed, Jay Powell, has said most of this inflation is transitory. It's not going to last. Do you agree with him or not? So here you have three selections. It's going to continue to run hot, it's going to slow, or you're not sure. So go ahead and put an answer down. I hope you put one of the first two. Don't wuss out and say, I'm not sure. Pick one. See what you have to say. So is inflation going to remain hot, or is it going to slow next year? Is Jay Powell wrong, or is he right, in your view? All right, let's take a look, see what the answers are. All right, well, pretty even here. The plurality, but not by much, think inflation will slow. But almost a third of you think inflation is going to continue to run hot, and about a quarter don't really know. And of course, nobody really knows. Let's go to the next chart. Nobody really knows whether inflation is going to moderate or not. We'll know only after the fact. So the blue line here is the consumer price index, which is the measure of inflation that most people think of when we talk about inflation. And this is the 12-month change in the CPI. And we got new data this week. It's not in the chart. We didn't have time to put it in. It didn't change the right-hand side of the chart really meaningfully at all. So inflation right now is about 5.5% above year-ago levels. And that's the highest that we've seen for quite some time. Now, we've got 10 years of data here on the chart, certainly higher than any period there. The tan line is a different measure of inflation. Turns out that if you look at the CPI, and the CPI is just a market basket of goods and services that people tend to buy. And the Bureau of Labor Statistics goes out and surveys people every several years to see what they're buying now. And they'll put that in the market basket. So the market basket changes over time. The tan line is what is called the trimmed mean CPI. What does that mean? It turns out that things that go up the most in 1 month or 2 months or 3 months then tend to go down. They don't tend to go up. They don't tend to be the highest risers forever. And the things that go down a lot might go down the most for 1 month, 2 months, or 3 months, but then they reverse direction and tend to go up. So the things at the extremes, the prices that go up the most, prices that go down the most, tend to reverse within a few months. So what we look at here with the tan line are the things in the middle, the things that don't reverse, the trimmed mean. So what does this tell us? Well, it tells us that in the middle of that market basket of goods and services that people buy, inflation is going up. Not nearly as much as the overall inflation rate. It's up about 3% above year-ago levels. And this trim mean CPI is a really good predictor on average of where inflation will be in the next year, much better than the inflation rate itself. So this tells us that inflation is going to come down next year, but it's not going to go down to where it was before COVID hit. So whether you said it's going to stay hot or it's going to go down, you're both right. Trick question. It's going to be higher than it was, but not nearly as high as it is now. A lot of the inflation we're seeing now are things that are being caused by supply chain problems. Well, those will eventually heal, and that inflation there will go away. Why won't inflation go back to where it was? I mean, the Amazon effect isn't changing. We're still going to go online and look at all the prices. Companies are still going to look for the lowest cost areas around the world to produce. All that's absolutely true. And if that's all there was, it tells us inflation should go back to the relatively low levels, the 2% that we had seen for the last 10 or 20 years. Why not? Well, one of the things we're seeing, and we're going to talk about this in a minute, is that the price to live somewhere, whether it's house prices or rents, are surging right now. And those feed into certain components of the CPI. And that's not going to come down, at least not immediately, perhaps not until the next recession. And that's going to keep the CPI, keep inflation from falling back to where it was before the COVID recession hit. But all those vast majority of prices that are up because of supply chain problems, within the next 6 months, we hope, certainly within the next 12 months, most of those prices will no longer be surging. And they may, in fact, have even reversed. A great example, lumber prices, 1,000 linear board feet, typically about $400, maybe $450 per 1,000 linear board feet. At the peak last spring, it was up to 1,700. Well, people wanted to have homes, and everybody who didn't buy a home wanted to add on to their house. So lumber demand just soared. At the same time, the lumber mills were closed down. Supply and demand, prices went up. Today, those prices are back down to about $500 per 1,000 linear board feet. And we're going to see that in product after product. Next chart, please. All right. Interest rates, because we're going to talk about housing in a minute. Look at 1981. I remember moving to LA to be a college professor in 1982 and having a mortgage rate that was 17%. For most of you in the audience, you can't even imagine mortgage rates at 17%. It's a nightmare for me because we actually had mortgage rates at 17%. But interest rates irregularly have been coming down since 1981. This is the 10-year Treasury note yield. You know, a year ago, slightly more than a year ago, 13 months ago, August of 2020, the 10-year Treasury note yield fell to an all-time low. Yep, interest rates in the US had never been lower, the whole history of the US, than they were last August, half a percentage point. Today, the 10-year Treasury is about 1.3%. It's still pretty low, and it's certainly one of the things helping boost housing demand. Interestingly, there have been some researchers who have looked, and you can find interest rates that go back thousands of years. Yes, thousands of years. The Sumerians, they kept very careful records when people borrowed money, how much it cost. And you can make the case very strongly that global interest rates in the second half of 2020 were the lowest in recorded human history. Now that's low. But rates, while they've come up some, are still darn low. Go to the next chart, please. We also look, and this is true both for jobs and housing, at population, and population determines households. So population growth has slowed tremendously in recent years, and the estimates from the Bureau of Labor Statistics, and these are BLS estimates, not our own, suggest that population growth will continue to slow. The population is not going to go down. It's just the growth rate is going to slow, and that is due almost entirely to demographics. Plus, we've seen a significant slowing of immigration, net migration into the U.S. For various reasons. But what this means is that the labor force is going to remain relatively tight for decades to come. Also means that ultimately the things that cause demand for goods and services, the growth rate of the population is going to be less. The growth rates of the demand for housing and things like that won't go up as much in future years. Next chart, please. Where over the last year has population growth been? Well, except for coastal California, population growth last year, all the MSAs, is the same as it's been really for the last 20 years. People move south and they move west. Now, clearly they're not moving to Louisiana, except perhaps for Baton Rouge and New Orleans. And they're not moving to coastal California, too expensive. But they're moving south and west generally. Where are they moving from? The Northeast and the Midwest. Those are trends that are likely to continue. Jobs are being created principally in the South and the West, although not totally. And you know what? The weather's a lot better. You don't have to shovel snow in Florida or Georgia or in Arizona. You might in Oregon and Washington, depending upon where you live, and certainly do in Idaho, Utah. But generally, people move for jobs and they move for weather. And we will continue to see that. So the strong job gains are going to continue to be South and West. Next chart. All right, so housing. So housing starts. You can see the surge in housing starts during the housing boom before the Great Recession. I worked at Fannie Mae for many years, and we used to laugh that the only mortgage requirement back in that period was the mirror test. What's the mirror test? What happens if you put a mirror under your nose? Well, when you breathe out, the mirror fogs up. Congratulations, you get a mortgage. And it wasn't much harder than that. And that has not been true since 2010 and beyond. Mortgages today are given to people who really can pay them back, not like it was back in 05 and 06. And we have a horizontal line here, average household growth. Now, multifamily starts are part of this as well. But generally, we have not built enough housing in the US for a number of years relative to the number of households that have been created. Every household has to live somewhere. You know, if you move in with your parents, you're no longer a household, you're in their household. If you move in with friends, like in the TV show Friends, you know, all the women were one household, all the guys were in one household. So the two households, regardless of how many people there were, you have to live independently to be a household. So we have created a lot of pent-up demand for housing units. We simply have not built enough. And people want houses today. You know, mortgage rates are near record lows. The job market looks pretty good right now. And there's this huge desire for space. You know, if my boss said, I can work from home, that's great, except I'm living in an apartment, or I'm living in a little house with a couple of kids and I got no office. I want a bigger house, or I want a house at all. So we're seeing a huge pickup in the demand for housing. Just at the same time that we continue to see not enough houses being built. Builders are building all they can, but there's a shortage of buildable lots. And builders, home builders, just like all other businesses, they don't have enough workers either. So not enough homes are being built. At the same time, the number of existing homes for sale is effectively at an all-time low. So the number of homes for sale in the US right now is well below the demand. Go to the next chart, please. Well, prices. We all know prices are supply and demand. So demand for housing is way up. Supply is not. What's happening to house prices? They're rising at record rates. Home prices today are rising faster than they did at the peak of the housing boom in 05. Does that make you scared? You see what happened to house prices in 09 and 10 and 11 and 12. They were down. Are we looking out in a few years? Are we going to see big declines in house prices again? Anything is possible. We could. But because this is being driven not because people are buying homes because they're getting mortgages they can't afford, but it's being driven primarily because we've had this lack of homes on the market. Once the housing market returns to normal, and it will, we're not going to continue to see 15 to 20% house price gains forever. Eventually, every dollar of income gets spent on housing, so we know that can't happen. But it doesn't mean house prices are going to collapse as they did in the Great Recession. They may go down a little bit, and they may go down in some areas. In all recessions, even before the Great Recession, there were certain parts of the country where house prices fell, but just not very much nationally. We don't think they'll fall nationally in the next downturn either. But prices are up a lot. Again, supply and demand. Next chart. Rental vacancy rates. Well, if you can't buy a house, you want to have a household, you rent. Well, rental vacancy rates are really low too. They've built many multifamily homes. A lot of households have been formed. So rental vacancy rates are way down, effectively the lowest they've been since the middle 1980s. And that's a long time. Let's go to the next chart. So just as supply and demand determines house prices, supply and demand determines rents as well. And rents have been going up a lot. In fact, rents have never been higher than they are right now. And this is the average across the whole US. So it includes San Francisco, includes New York City, but it includes mid-sized cities like Columbus, where I am, includes little cities out away from where the big cities are. It includes rental properties in non-city areas, little towns. So it includes all of those. And you can see that big jump in rents starting the second half of last year. So whether you're buying a home or renting a home, one, it's hard to find them. Two, the price is up a lot. So for those of you in the relocation business and you're moving people from one city to another, it's not easy to find places for them to go. It's the one thing that helps mitigate that is that many more businesses today are willing to have workers work remotely, at least for a period of time. But if you're moving workers, from LA to Chicago, or from I don't know, San Francisco to Boise. That's not a good example because nothing's more expensive than San Francisco. Let's say from Memphis to Charlotte. You're going to see prices higher for both houses and for apartments. Next chart, please. This just shows multifamily starts. They're up a lot, but it's not enough. We're simply not building enough homes. As I said, the number of homes for sale in the US today is well below demand, and continues to push prices higher. Next chart, please. Now, our lawyers at Nationwide tell me this is the most important chart I can show you. It's our disclosure. What does it mean? Everything I'm talking about that's going on in the economy now or in the past is real data. The forecasts that were forecasts and stuff. We know every forecast is wrong, all of them. They're only right, they're only exactly right by accident. The question is, are they wrong by just a little bit? And hopefully ours are just wrong by a little bit, or are they wrong by a lot? Hopefully they're wrong by a little bit, but just to let you know, they're forecasts. So that's all I have to talk to you about today. Hopefully you all have some questions. And again, if you've not put your questions in yet, please put them in now. This is your time. And you can ask me to talk about whatever it was you actually wanted me to talk about instead of what I wanted to talk about. So thank you all very much.
David, always appreciate your data-rich insights, and I know that I'm sure folks are already thinking through how do I make connections between this particular macroeconomic trend and X strategy or X operations that I have in place. Quick question just to kick us off. As we looked at population growth and the impact on the labor market, how are you seeing companies really try to tackle that in innovative ways? Is it higher investments in technology that automates processes, or unique ways to attract talent or share talent in the marketplace?
Well, what's interesting is it's not just one industry. It's not just one part of the country. It's basically all industries in all parts of the country that we're seeing shortages of workers. So we're all in this together. In a lot of ways, that makes it harder because everybody is going to try and do the same thing. So everybody you're competing against is going to be doing what you're doing. And it's lots of things. It's reaching out and training workers who perhaps you wouldn't have thought of before. Perhaps you're a white collar firm and you hire people who work in a factory, but you train them. So there's lots of training going on by companies themselves. There is, as you said, lots of new technology happening. So if firms can't get workers, they replace them to some extent with machines, often very high-tech machines. And those are the two things that we're principally seeing around the country. Now, of course, firms are trying to find workers wherever they can. They're going out to local universities, community colleges, forming partnerships with them in whatever areas that they think the graduates can bring good skills to work with them.
Yeah, it's an incredible marketplace. I'm hearing just on the data side, data analysts are in such high demand. Oftentimes, there was just an article that I read, they've got 2 to 3 jobs here at the same time, with a wall full of screens and not one knows of the other. And so it is an interesting time. Ryan,
what's interesting is the folks who are in data analytics, they were in short supply before the COVID downturn. And they would job hunt and job swap and get higher and higher incomes. And now they can work from home exactly as you said. They may have multiple computer screens in their home office, each with a different employer. You know what? If they're doing the job, I guess that's okay.
Yeah, yeah. No, it'll be a little different on the manufacturing side, I would imagine.
It is hard to work remotely if you're in manufacturing. No question. You need people in the factory, even if you need fewer than you did 5, 10, 20 years ago, because of productivity gains, because we have automation and machines that can do so much. You still need people there in the factory.
Yeah. Ryan, I'll pivot over to you.
Well, a related topic. So Jen and I have talked over time about digital nomads. So David, given the housing landscape or market that you've painted for us, when people are locked out of markets by virtue of lack of availability or pricing or some combination, how do you see that, or do you see that making a concrete shift in the workplace? And how do you see employers responding?
I think employers, particularly in the high cost areas, are going to have to be far more flexible going forward. And they're flexible right now in terms of location. I moved to Columbus from San Francisco, a very high cost area, the highest cost area, to a relatively low cost area. But if it was the move the other direction, it's very difficult for employers in, say, Silicon Valley to get people to go there unless they're just starting out and they're happy to have 5 guys live in a 2-bedroom apartment together and commute a long way. So it means that employers in the high cost areas have to be far more willing to be flexible on where people work, the hours they work. It is the best time to be a worker that we have seen in decades. They can't write their own ticket, but it's the next best thing to that. It makes it very hard for employers. So employers have to be far more flexible than they've been in recent years.
Makes sense. Jen, did you see anything in the Q&A box we want to tee up to David?
I got one here on the side, and it's around Bitcoin. I guess it's tied to inflation, some of your economic metrics like inflation, for example, and new currencies around Bitcoin and the impact of Bitcoin on different economic measures and indicators.
So at this point, the cryptocurrencies they don't meet the standard definition of currencies. There are a few places you can use a Bitcoin to buy something, not many. And what is Bitcoin today? 45,000 per coin. You're going to, AMC movies will let you use them. Are you going to go buy popcorn with a Bitcoin? Yes, and it's not a real thing. It's on your phone. Nobody's really using them in that way. They're using them as in 2 ways, perhaps. They're using them in way one is the way people use gold. I'm a little concerned about inflation. Currencies may be debased. Maybe I'll buy some of these, and if inflation goes up, the price of these will go up too. Now, we don't know if they will because these are all new. We don't know how they're going to act. But people, at least some people, think it's an alternative to gold. And so they're using it as a store of value. But we'll see if it works out that way. They're all based on blockchain technology, and blockchain is a brilliant thing. I think most people who look at it think eventually most countries will, if they don't move completely to a blockchain, will at least partially move to a blockchain. But that doesn't mean soon. It also doesn't mean that the private cryptocurrencies such as Bitcoin and Ethereum are the ones that will survive. The central bank, the People's Bank of China is a great example. They don't like these at all because you can go off the grid, and the People's Republic doesn't want you to go off the grid. But it may be that at some point the Federal Reserve wants to have its own cryptocurrency. It'll be blockchain. It'll be very safe. Use it just as you would Bitcoin. But that would make the value of the privately held cryptocurrencies diminish significantly.
Yeah, yeah. Thanks, David. It's interesting to see what countries are doing, whether it's China or El Salvador in the crypto space.
I was watching on CNBC this morning, I was on the treadmill, people who didn't want to have to use Bitcoin attacking a Bitcoin ATM and destroying it in El Salvador.
But that's certainly probably not the intention. Ryan, anything on your end?
Yeah, let's pivot just maybe one more time. So we're going to go back to the housing market with this one, David. So question, what do you see in the way of the impact of some of the online rental platforms, VRBO, Airbnb, the impact that they're having on availability, particularly in the single family home market?
You know, they are anywhere where they exist, removing units from either the rental stock or the for sale stock. How much depends upon, you know, how big they are in a particular area. And in some metro areas, they're a reasonably large portion of the housing stock. But they're not, they have not been set up principally for longer term rentals, such as a relocation. That doesn't mean they can't. And one of the things I think that could help alleviate some of the housing shortage is if businesses or relocation firms get together with the short-term rental folks such as Airbnb and create longer-term rentals for employees who are moving to an area. But the short-term impact, because they're not really doing that now, at least not to a large extent, is to take units away from the rest of the market, which pushes prices up.
That makes sense. Well, thank you for that perspective. It does look like we're drawing close to the end of the hour, and I've got a couple of just closing comments to make. David, first of all, thank you so much for your perspective, your expertise, and your partnership as we collaborated on this webinar. And Jen, the same goes to you. Just can't express how thankful we are for this partnership, for the for the opportunities that this hub relationship has opened up for Altair. As I have previously mentioned, this webinar has been approved for HRCI and CRP credit, and those activity IDs are listed here, as well as the downloadable handout for your convenience. And so with that, without further ado, I suppose from all of us at Altair Global, Hub, David, on your behalf, we thank you for attending and wish you all a great rest of your day.
Thanks, everyone.
Thank you.